All right, Kai, we're about a minute and 45 seconds out. I'm going to go ahead and stop share on my side here. If you want to go ahead and load that slide presentation up.
Is that good?
All right, slide looks great. Camera looks good, framed nicely. We will kick off here momentarily. I'll be back with you shortly just for a quick intro, and we'll be ready to go.
Sounds good.
All right, everyone, welcome back to Money Show's virtual expo. We are pleased to welcome Kai Wu, the founder and chief investment officer of Sparkline Capital, an investment management firm applying state-of-the-art machine learning to uncover alpha in large, unstructured data sets. Before Sparkline, Kai co-founded and co-managed Kaleidoscope Capital, a quantitative hedge fund in Boston. Previously, he worked at GMO, where he was a member of Jeremy Graham's asset allocation team. Kai graduated from Harvard, magna cum laude, and Phi Beta Kappa. Kai, thank you so much for taking the time out today. It's all yours.
Well, pleasure to be here, and thanks so much for saving the best for last. I know it's kind of the end of the day, so we'll get to it. Um, now, so the first thing is, we are an SEC registered investment firm, so I just need to make the necessary disclaimers that everything I want to talk about today is for information purposes only and not a solicitation for any security or fund, including ours. So let's start with the intangible economy, which is the topic today. And my thesis here is that the economy has changed a lot over the past century, transforming from industrial to asset light. And the challenge for value investors applying, the traditional techniques of Ben Graham and David Dodd is that because of these changes to the economy, a lot of the metrics that were applicable in the industrial era no longer work today. So before we jump into it, let's set the stage and ask the question of what are intangible assets? I would argue that intangibles are modern economic moats. They're what allow companies to earn cash flows and earn returns that are far in excess of what you could expect simply investing in on the basis of tangible capital. Now, there are four categories of intangible assets that we focus on here at Sparkline. The first is intellectual property. That's not just patents, but also proprietary know-how, software, data, technology. Then there's brand equity. And that's, think about companies like Disney or Ford, would allow them to excel. On the human capital side, it's not just having a talented employee base, it's also having these employees be aligned around a common objective, rowing in the same direction, so to speak. And then finally, there are network effects. And this is, this off-balance sheet assets that some companies have, whereby external ecosystems of producers and consumers create value for them. Think of companies like Facebook or Uber, or even, traditional telecoms like AT&T, whose network value increases as more people join the network. So now the question becomes, why do intangibles matter? And I kind of already said this, but the economy has transformed considerably over the past century. Here's a quote from Warren Buffett, one of the most famous value investors, from a few years ago. He said, "The four largest companies today, by market value, do not need any intangible assets. They are not like AT&T, GM, or ExxonMobil, requiring lots of capital to produce earnings. We become an asset-light economy." So how do we want to measure this? Well, there are a few ways to do so. So the first thing we can do is build up the balance sheet of U.S. corporations bottoms up. And if we do so, we find that somewhere between 45 to 65% of the assets that create value for these companies are intangible, with the balance, of course, being tangible. Another way of looking at this is focusing on the S&P 500, which is kind of the most investable index. So this is a cohort of larger companies, public companies. And we of course know the largest ones in this category: NVIDIA, Microsoft, Apple. And in this case, the percentage of capital that's now intangible is even higher. somewhere between 65 and 75% of the value of these companies are in high intangible industries like technology, healthcare, and consumer brands. Another way of looking at things is to step back from the stock and think about the flow. So in the national account data, we can look at how much investment firms are making, the private sector is making into intangible versus tangible capital expenditures. And what we find is that $7 trillion is being currently spent on an annual basis by companies to create intangible assets. And that could be R&D, it could be marketing and sales, it could be employee training. And what's really important about this to remember here is that, even if you go back 20 years, it was the other way around, where physical capital expenditures, the construction of factories and building, land, that was actually the greater of the two. And intangible capital only crossed in 95, but is now significantly higher, as a share of overall GDP. So what's the problem? Is that investors have struggled to adapt. And if you go back to kind of your accounting 101, financial statements, what you find is that these statements generally ignore intangible assets. So here's a quote from Baruch Lev and Van Gu, who are two accounting professors. This is from their book called The End of Accounting. And they said, the constant rise in the importance of intangibles in companies' performance and value creation, yet suppressed by accounting and reporting practices, renders financial information increasingly irrelevant. Now, if you look at the lower left of the slide, you can see for each of the four pillars I mentioned, IP, brand, human capital, network effects, how US accounting, GAAP accounting, treats them. In the case of IP and brand, the problem is the way they're expense, not capitalized. So a traditional dollar spent on a physical capital expenditure, say building a factory, would actually end up becoming a asset on the balance sheet of the company doing this. Whereas a dollar spent on R&D is not capitalized. In fact, it actually ends up being expense. So it comes out of the net income of this company. So effectively, companies that are embarking on homegrown innovation, research, and marketing are now penalized. And then on the human capital network effects front, you have very limited disclosures at all. Like no disclosures on network effects, which are fully off balance sheets. And on the human capital side, you see headcount, but of course, you're not distinguishing between what any of these employees are doing. And the upshot of this empirically is shown in the lower right. And this is from that same book by Lev and Gu. And they show here the explanatory power of two key headline accounting metrics: reported earnings and book value. So that's tangible book value. And what was interesting is, go back to 1950, it turns out that 90% of the variance across companies in the market values can be explained by these accounting metrics. But then with each passing decade, that has declined by about 6 percentage points. So such that by today, it's only around 40 to 50%. So it's more than halved in the explanatory power due to the rising importance of intangible assets that are not being captured in these sorts of metrics. And what does this matter for investors? Well, here's kind of the problem, which is that most value investing techniques go back to kind of your security analysis by Ben Graham. In 34, he wrote this book, and the idea was to look for companies that were trading below net liquidation value, below tangible book value. And that worked really well in the 30s, 40s, 50s, and up until really the mid 2000s. So what this line shows you here is the Fama-French value factor. And Fama and French were, are some very well-known professors who've kind of codified this in academic research. And what they found is, and what they did was they defined this factor that's basically long the top 20% of US stocks on price to book, so the cheapest 20%, and then short the bottom 20%, the most expensive on price to book. And what this line shows is the relative performance of those two cohorts. And it is designed to kind of show the performance of systematically buying cheap stocks on price to book. And what you find is that, for 60 years, this systematically outperformed by 5 percentage points per year, pretty consistently. And then around 2007, around the financial crisis, this kind of went in reverse. And this book value metric has underperformed now for over 15 years straight. And if you look at it not just relative to where its high watermark was, but relative to where the trend line would have it, what you find is that it's in such a deep hole that it would have to increase by 440% just to get back to trend line. And so, this is the point of the slide is that it matters, right? Okay, so it's a little bit abstract of a concept to say, oh, well, like accounting metrics don't explain as well. But if you look at this, and what you find is that for the vast trillions of dollars following either strict value indices like the Russell 1000 value, MSCI value index, or even more active managers who are using screens on price to book, price to earnings, these sorts of metrics. This shows that those things have systematically underperformed and been a drag on performance over a long period of time. So how do we solve this? Let's start with this quote. This is from my research paper that we rewrote at Sparkline in 2021. And we said, we like to call intangibles the dark matter of finance. For while intangible matter holds the financial universe together, it is not visible to the naked eye. Fortunately, the digital age has also triggered an explosion of new data and tools, enabling us to start exploring this brave new world. Let's start with the data, okay? What this slide shows is the explosion of digital information that we as investors and just humans have been able to leverage over the past decade or so. And you can see, of course, this exponential increase in the amount of data created. This is just the exhaust of the digital age. Now, if you squint and look at the blue versus red, what you'll see is that I divided up this data into two categories: structured data and unstructured data. Okay, so structured data is information in Excel spreadsheets or relational databases like SQL databases. The most relevant, of course, for investors are stock prices, volume, price to book ratios, which I mentioned, price to earnings ratios, stock fundamentals. Now, this data is not only much smaller than the total, but it's also the one that's been the most picked over by investors, right? We have plenty of PhDs and quants have been looking at this data for a long period of time, looking for inefficiencies to potentially exploit. The unstructured data, on the other hand, is kind of more greenfield. It's information that is captured in video, audio, text, or even semi-structured data like email, web pages. And that comprises over 80% of the outstanding information today. And more importantly, that this information also contains, as a subset of it, some very useful insights onto intangible assets. As I mentioned, IP, brand, human capital, network effects. And I generally would categorize these things into three subcategories. So the first are company communications. So for example, in the annual report of companies, the 10K, they have the management discussion and analysis section where the CEO will talk about how their year has gone and kind of give guidance and expectations around the future. The same with the quarterly earnings calls or press releases or the company website itself, right? So all this information, which is unstructured data, is potentially indicative of various elements of the company's intangible assets. The second category are third-party analyses. And now this is the news media, it's sell-side research, investment blogs. I had to put this here, financial Twitter. But any opinion that is not from the company itself, but from a kind of third-party source. The final category is what I would call ground truth. These are things like patents, trademarks, LinkedIn bios of the employees working at a given company, the customer and supplier data. This is information that is, not subjective in the sense of it's what the company wants you to think about their business, nor is it what, the Wall Street Journal wants, the editor there wants you to think about a given business. This is just the information. This is just how many patents does company X have and what do they say. Now, the challenge with unstructured data is that it's very large and very messy. We just saw that it's, most of the outstanding volume of data, but not only that, but it's also very hard to work with using traditional tools. Like you wouldn't take a multi-hundred word patent abstract and throw it through a linear regression. That wouldn't give you anything useful. So what you need specialized natural language processing tools in order to parse and process this information. You can do something as simple as a word count, right? Just count the number of times the patents say AI, right? From there have been many other kind of more advanced techniques. Next, we had word embeddings, and then all the way to full-fledged large language models. So in 2018, I note was when the GPT-1 model, which is the kind of early iteration of what now is ChatGPT, and then BERT, which is Google's version of it, were invented. And that was really a game changer. And that was when I personally started getting really involved in AI. I was training my own large language models around this time. And kind of recognize that we're now living in this kind of interesting confluence of two things. One is an explosion of data, which I just showed, and two is an explosion of technology, which now allows us to unlock the value in this data. And so what we do is we take all this information from these various data sets, patents, trademarks, job posts, social media, employee reviews like Glassdoor, And we kind of throw it through various quantitative tools, including large language models, but other things. And from there, we end up with structured factors. So imagine like taking a patent and saying, I'm going to score each one on a score from say 0 to 100 based on how innovative it is. And that's kind of what we're doing. So we're converting unstructured data to structured factors. And we have hundreds of these things. The key insight here is that they are value metrics. They're all normalized by price. So in other words, it's not the number of patents you have, it's how much patents you have per dollar invested, similar to a dividend yield. Or tangible book value, like book price to book ratio. That's saying for each dollar invested, how much book value do I get out? For each dollar invested, how much dividends do I get out? Now we're saying for each dollar invested, how much IP, human capital, brand equity do I get out? And then what we can do is we can just kind of put it all together into a single composite. We already saw tangible value, so we can look at price to tangible book value. But we want to now expand this to include not just tangible value, but intangible value as well. So that our definition of intrinsic value has now expanded to include not just tangible, but intangible. And we do that by kind of summing across the four pillars I mentioned. So we take all our metrics for IP, blend them together. That's your IP score for each company. Do the same for brand, same for human capital, and then take those four things, sum it with tangible value. Now you have the overall value for each company. Here's an example of how we can do that. This is for four companies. This is from the paper I mentioned from a few years ago. And what you can see is that at least for the first three companies here, most of their value is intangible. So Boeing, Coca-Cola, and Google. The blue bar, I'm sorry, is the tangible capital is either zero or close to zero. So in the case of Boeing and Coca-Cola, if you're spending hundreds of billions of dollars on R&D and marketing, and that's not being capitalized, you don't get that balance sheet asset for it. It just kind of washes away. And so what are you left with is not much. In the case of Boeing, their primary asset was intellectual property. In the case of Coca-Cola, brand equity. For Google, it was more of a blend of different things, IP, human capital, and network effects too, right around Google search and all the data they have on us. And then for fun, I also threw an Aflac and did the analysis on that. A traditional insurance company, they have some brand equity because they have a cute duck, but most of their value is tangible, as you would expect for an insurance company. Now, let's do this at the sector level. If you look at all the way to the left of this chart, you see that technology, healthcare, and communications are the sectors that are most intangible, right? Over 75% of their value is intangible. And then as you go to the right, you'll see real estate, utilities, materials, energy, financials, or your kind of traditional old economy, asset-heavy industries. And then what you can look at is for each of the four intangible pillars, what sectors do they matter most in? Technology and healthcare, and to some extent industrials, rely more on intellectual property. Human capital is important for tech, healthcare, but also finance. And then finally, brand is most importantly, obviously, for the consumer sectors, both discretionary and staples. And then network effects, primarily communication, which includes, again, both your kind of more modern companies like the Googles of the world, but then also your traditional telecoms. So here are some actual examples that we have here. And what I did here was I said, let's look at, for each company, its primary pillar. Right? We all know that, as I showed you, Google has a mix of different assets that constitute its balance sheet. But if we just say we're going to go for the single biggest one, in this case, it would be human capital. If we do this, it kind of just makes it a little bit cleaner and easier for us to kind of conceptualize and understand intuitively what this analysis is doing. Basically, we're bucketing each stock by what is the primary driver of its value. So in the case of IP, you have companies like Oracle and Qualcomm, Pfizer. For brand, Disney, Hasbro, Amex. Human capital, Goldman Sachs, Meta. And then network effects, Amazon, DoorDash, AT&T. And finally, what we can do is we can now wrap it up and create a portfolio of the top 20% stocks on this score. So if you remember back to what I did, first in the beginning of this session, I showed you the Fama-French factors. What that was, if you remember, was taking all the U.S. stocks, looking at price to book ratios, and then buying the top 20% and then comparing that to the bottom 20%. We can do the exact same thing. This time, we don't use price to book. We use price to book plus intangible, right? So we have a kind of more holistic measure of intrinsic value against which to compare price. And then what we end up with is this portfolio here. And you can see, a lot of the same names that I showed you before, Google, Oracle, IBM, Accenture, Disney, Amazon, Wells Fargo, kind of across the different across the different spectrums. The intangible capital across the four buckets comprises over 85% of the total. The blue is only, say, 15%. But that's not to say that there's no value in tangibles as well. Obviously, you wouldn't want to not give credit to a company for having, say, a lot of real estate in its portfolio. And so you end up with this sort of portfolio. And then what we can do here is we can say, how would this have done? So this is a back test, right? So, obviously this is prepared with the benefit of hindsight and is not like an actual portfolio, but we've done it in the exact same way as the academics did, the exact same way that Fama and French did it. So you can see in the blue, the line from before, right? And we run it all the way up into 95. When we start, we splice on the results of this new portfolio that again does the same thing, but now invests in intangible capital as well as tangible capital. And what we find is that while the traditional Fama French value factor has decayed and is now in this deep drawdown, if you kind of add back tangible value, so it's not just tangible, but intangible as well, you end up kind of solving the problem and things continue to go. And so what's the conclusion here, right, is that the principles of value are timeless. Like some people are out there saying, look, value investing is dead. It's never coming back. We should just buy meme stocks. But that's not right. I mean, by definition, if you're buying stocks below intrinsic value, you should make money. The reason why the school of traditional price to books, old school value investing has struggled over the past 15, 20 years is because they're looking at the wrong metrics. They're looking at tangible capital when it's intangible capital that matters today. Right? If you think about what tangible capital is going to give you, it's going to give you a lot of old economy companies and firms that have not done as well and have kind of missed out on the growth of this intangible economy that, as I mentioned, has gone from basically nothing to being 50 to 75% of the economy today. And conversely, look, if you're sitting here and you're saying, I'm a value investor, I'm only going to buy stocks that are below price to book ratio, you're not going to give companies like Google credit for its intangible assets. Well, then you're always going to be short or underweight those sorts of names. And these are, of course, the guys who have done really well the past decade. And, not speaking specifically to any one company, will, as a category, likely be those who will continue to thrive moving forward as the world will only become more intangible over time. So lastly, I want to talk about intangible value today. So where is the value today, right? So what I just showed you was, here is the problem, and here's a solution, and we're going to build a new framework that can allow us to assess value in a different way, right? So how does it look like today? Well, on the left, you can see what tangible price to book or price to earnings kind of traditional metrics would give you. You're kind of, same old companies, banks and insurance, oil and gas. And by the way, if you look back 10 years ago, it would have been the same names. These are the names that, as I mentioned, have not done so well. They've kind of been more stagnant. They haven't really benefited from, all the kind of innovation and changes we've seen, as the economy has become more asset light. But now, if we take not just tangible capital, but add back intangible value as well, we have a totally different cohort of companies. Now, I just kind of picked two examples here for the sake of this presentation. So the first are what I would call old economy AI early adopters. Right? These are effectively guys who may be industrial, may sit in kind of the old economy bucket, but they are investing heavily in kind of the digital transformation, investing in AI or whatever technologies are required in order to then compete more favorably against their other peers who are also not necessarily kind of the most cutting edge on technology. And the good thing about these guys, they trade at a pretty big discount. Now, if you step back, one of the things that we like to do at Sparkline is conduct historical analyses. And we wrote this paper where we looked at the last big technological revolutions, going from the railroads to automobiles to electricity to the dot-com boom in the late 90s. And in particular, the dot-com was very interesting, right? Because what you found is that, in the very beginning, it was the innovators, the kind of NVIDIAs of the day that were kind of the best stocks to invest in. Right? If you could predict the internet, then of course you want to be in the most internet exposed companies. But at some point, what happened was that those companies got really, really overhyped and really overbid. Right? Cisco, think of like AOL. These companies are trading at huge valuations, and if you bought those stocks and you kind of fast forwarded 10 years, you would have lost money. Even though their earnings grew rapidly because the internet actually became a thing, you would have lost money because you overpaid. And I think the same, and I think the same lesson translates today, where it's like it's not where you want to kind of play the cycle in a dynamic way. Start off by the innovators. At some point, as they become expensive, rotate into the kind of more under the radar names, what I would call the early adopters, guys who are, in kind of the more traditional sectors, but who are, who are eagerly embracing the technology, which presumably should allow them to, beat their competitors. The second category are non-US consumer brands. So one of the big themes recently has been the outperformance of international stocks. Ever since Liberation Day and even a few months beforehand, we've seen a huge rally in, non-US stocks, both developed and emerging. And part of that's driven by the decline of the dollar, but even in local currency terms, these stocks have excelled. And many investors are finding themselves a little bit offsides, right? Because the U.S. has done so well for so long. Many of us, have let our winners run, and are like, wow, maybe I should rebalance and diversify. Now the problem is that a lot of the a lot of the international indexes, think of like MSCI EFA, right, the traditional non-US index, they're like 50% banks and some say industrials, very old kind of old school names. And if you look back 10 years, these companies have not grown. Their earnings are literally flat in real terms. And so that's the reason why, of course, that they're trading at such a big, deep discount. But obviously, not all companies are the same, and is a subset of non-US companies that are actually, kind of at the top of their game, as good, if not better, than many other US peers, yet trading at a huge discount. And that is consumer brands, right? So think of like, the kind of luxury brands in Europe, auto companies like Toyota or, Mercedes, BMW, guys kind of in the mid tier and even lower, right? I mean, Europe is known in particular for kind of being kind of the old world. They have this great tradition behind their companies, and many other countries, they have their own kind of local monopolies, almost like local brands that maybe we haven't heard of that much in the US, but are very powerful amongst a local consumer base. And so I think that's a really interesting category of names that you only get surfaced when you use intangible value. If you use just tangible, they kind of seem expensive. But once you start kind of giving companies credit for their brand equity, for their IP, then these other types of companies come into play. So the takeaway here is that if by expanding your definition of value to include intangible assets, you are able to kind of transcend outside of the traditional value sectors into areas that are kind of the purview of more growthy investors, but still approach it with a value lens, so that you're looking for kind of the discounted stocks and you have a margin of safety when you're buying them. You're not just kind of like aping into the growthiest names out there. So I need to wrap up soon. So this will be the final slide. The takeaways from this presentation. We'll just kind of tie a bow on this. And so the tagline here is that value investors must adapt to the rising intangible economy. The first thing I showed you is that intangible assets have become the dominant form of corporate value, going from basically nothing to over 50% of the value of, say, US companies. The second thing I said was that, the death of value investing, that traditional value has really struggled, and it's due to limitations in accounting information, limitations in the omission of intangible assets in their valuation metrics, and hence a bias against the companies that have actually done well the past 2 decades. Now, the third point that was made was the idea of quantifying dark matter. If intangible value is kind of the dark matter that holds the universe together, it explains why companies make money and why others don't, but it's hard to measure. We need new tools and data. And that's why I introduced the idea of unstructured data and large language models and other data science tools to take all these kind of these alternative data sets that few people are looking at and create structured scores out of them that can then be used to help quantify intangible assets. And then the final thing is, what do you do with all this information now that you have it? Well, why don't we try to modernize value investing? Why don't we look for companies that are strong, that are cheap, not just on tangible, but intangible capital, with the idea that we're now able to apply this timeless lens of, the kind of tradition of Ben Graham, Warren Buffett, the idea of a margin of safety, outside of kind of just industrials and banks, which are maybe less interesting in many cases, and to the growing sector of the economy that's intangible, right? Brands and services, businesses, and technology that is becoming, a greater and greater share of the economy. From basically 30% to now 70% today. These are companies that cannot be ignored. And so simply saying, I'm going to look, just kind of run my old playbook, and like not bother with, trying to buy any of these new companies, you're going to get left behind. And so I think it's very important to be open-minded and attempt to adapt to the economy that is almost certainly quite different than it was 100 years ago. And I guess just a quick shout out for my firm. We do a lot of research. This talk was based on a single paper. We do a bunch of other interesting research. So you're welcome to go to my website and check it out. And would love to kind of hear from you. So thanks so much. I have 1 or 2 minutes left. I don't know if there's any questions, or if not, we can just kind of wrap a little bit early. I know it's past 5.
Yeah, Kai, thank you so much. We had a question, Roland, that said, how can investors identify and assess uh, intangible rich firms in international markets to potentially gain exposure to growth and diversification?
Yeah, so I mean, I outlined a few metrics up here that you could use, and this is assuming you're trying to do it yourself. Um, Kind of the easiest thing to look at is R&D, right? So R&D is contained in a lot of different financial statements. You have to be a little bit careful internationally in how you look at it because different countries have different accounting standards, but that can be accounted for. So companies that are cheap relative to their R&D, those tend to be an interesting starting point, right? So you don't even need if you go down that path, you don't even need to like add a lot of this alternative data. That would be a good way to start screening. I think also you can look thematically, right? Like, kind of the example I gave you down here with the old economy AI adapters and non-US consumer brands, right? Like the non-US consumer brands, that wasn't like me going top down, but I was just kind of like running my screens, running the model. I basically run my model for all the stocks in the investable universe, 5,000 stocks, and kind of like just bottoms up get the best portfolio on that metric. And what I noticed was, oh yeah, a lot of these stocks are actually in this kind of category. They're all kind of thematically linked. So that's interesting, right? And so I would say that's another way of doing things, like kind of looking for themes that might be interesting today, and then trying to assess them on intangible value.
All right, Kai. Well, thank you so much for taking the time out of your day to join us today. Greatly appreciate it. Let's do it again.
Awesome. We'll do it again. Thanks, Mark.
All right. Have a great one.
Thanks, everyone. Bye.
And a big thank you to everyone in attendance of Money Show's virtual expo. Thank you so much for being here. Be sure to check out moneyshow.com and check out the calendar of events for our next virtual events. So pleased that you were able to join us today, and we will be back with you. This concludes the last session of the event. Thanks so much for being here. We'll do it again soon. Good night, everyone.